This is Sir Fahad again with a video, and this time the video is again on books of prime entry. There are some confusions amongst the students, so that's why I'm making the video again. Starting from the scratch, from the first concept which was taught in accounting. Non-current assets. Non-current assets are resources owned by the business. Examples include machinery, motor vehicles, cars, and furniture and fittings. Current assets, those assets which are changing within a year. For example, inventory, accounts receivable, cash in and cash at bank. Accounts receivable, we refer to this name. This is according to the business terminology, accounts receivable. But as far as slang language is concerned, in slang language, accounts receivable is called customer. So in accounting we use accounts receivable, whereas in normal layman language we will say it is the customer of the business. Non-current liabilities, financial obligations for more than 1 year. For example, bank loan to be repayable in 5 years. Current liabilities, financial obligations to be repaid within 1 year. Example includes accounts payable / supplier, but we don't use the term supplier in accounting because that is not the terminology of accounting. We always refer to the term that is accounts payable. Now we have capital expenditure and expense on non-current assets which increases, or any expense which increases revenue generation ability of the business. Now I will put this concept aside, capital expenditure. First of all, we will refer to the rules of ALCER, ALCER. For assets and expenses increases on the debit side, and whereas liabilities, capital and revenue increases on the credit side. If we are to receive some amount from our customer in some duration. For example, I have sold something today and now I'm about to receive some amount after 15 days. So do I have a right to receive that amount? Yes, I have a right to receive that amount. That amount belongs to me because I made the sales, and now the customer will pay me later. So if the customer will pay me later and I have to receive that amount, then it will not be considered as liability, because liability is financial obligation. So that is my current asset. For any goods sold to any customer, the customer will settle his or her own account within a year. And if the customer will settle his or her own account within 1 year, so we will call it as current assets. And in accounting we will say it is accounts receivable. And as far as any supplier, for example, I bought something from a supplier and I am saying this thing to my supplier that I will pay you after 1 month. Same is the case with the supplier. Whenever we are saying we will pay, our customers will pay within a year, then this is by default that we will also pay our suppliers within a year. This is the rules of OLS accounting. So we will say this thing, accounts payables is the supplier. So accounts payable, I have to pay my supplier. So that is a liability on me, because liability is financial obligation to be settled in future time period. Till now, be clear with the concept. If you are thinking that you are not clear, then rewind this video, reverse this video and watch the earlier concept again. Now coming back to a question of books of prime entry. I have a question of books of prime entry. It is saying Jim D sells goods to Farhan. Okay, first of all, I would say Jim D is the supplier, is the seller, sorry, and Farhan is the buyer. Okay, till now we are clear. Jim D is the seller and Farhan is the buyer. On 1st May, Jim D owed Farhan $3,000. Okay, the following transactions occurred in May 2018. 5th May, Jim D sold goods on. These are all transactions required. Prepare the account of Farhan in the ledger of Jim D for May 2018. This is a little trick here. For Jim is a seller here for Farhan. Obviously, Farhan is supplying goods to Jim. Jim is the seller and Farhan is the buyer. If we are seeing this, if we are observing this thing from the seller's perspective, if we are observing this thing from the buyer's perspective, that is the Farhan. Farhan is a buyer. So for Farhan, Jim is the seller. Jim is his supplier. If the question is asking, then make the accounts of Farhan in the ledger of Jim D. If Farhan is saying Farhan's ledger will be used, for example, for making the account of Jim D. For Farhan, Jim D is the supplier. Farhan has to pay Jim D for all of these transactions. Supplier means accounts payables. Accounts payables is current liabilities, and liabilities always increases on credit side. Those things, for example, liability is increasing on credit side, so the by default nature of liability is on credit side. So the balance BD of liability will be on the credit side. So we will write down the date is 1st May. Now we will say balance BD because it's a liability, so that's why we are starting this account from the credit side. Liabilities increases on the credit side, so by default the nature is on, or the account of the T account nature is credit side. So we have an account of 3000. Farhan has to pay Jim D 3000 on 1st May. Now we have a transaction on 5th May. Jim D sold goods on credit to Farhan. List price 3000 less 20% trade discount. If Jim D is selling goods to Farhan, then Farhan is purchasing goods. So for Farhan it is purchases. So we will write down 3rd May. 3rd May, we will say purchases, and the amount is 3000 less 20% trade discount. Whenever we record anything, trade discount never ever comes in any books, but we will record trade discount only in our invoices. So this is not an invoice, this is a T account. We will record we will not record trade discount, but we will record the amount after deducting trade discount. 3000, 10% of 3300, so we will say 20% of 3000 is 600, so the amount is 2400. I hope you understood this thing. 3000 minus 600, 600 is the trade discount which is deducted before recording it into the T account. Now we have 7th May. Farhan returned goods purchased on 5th May. List price 300. This is a little trick here. On 5th May, Farhan purchased goods after deducting the trade discount. List price is the sales price. Did Farhan purchase the goods on the selling price? No, obviously not. Farhan purchased the goods after deducting the trade discount. So here in 7th May, it is giving us 300 list price. List price means the selling price. If Farhan did not purchase it on the selling price, so how come he is getting those amount back, getting the full amount back? This is not a scenario, this is against the logic. So we will say 300 list price of those goods. Now we will deduct 20% discount from these 300. We will say 300 into 80%. We can only recover the 80% of the goods, 80% of the amount of the goods which are sold. For example, the list price for the selling price was 300, but 20% trade discount was allowed when Jim D was selling us goods. So we will deduct the discount from the returns too, because we cannot recover the full amount because we purchased the goods after deducting the discount. So we will write down 7th May. Now we have purchase returns. Obviously, if we made purchases and now we are returning, so those will be purchase returns. We will write down the amount 240. Now we have 18th May. Farhan paid the balance of his account, and we will say and was allowed 5% cash discount. On 1st May, the balance BD, Farhan paid the amount which was outstanding on 1st May. On 1st May, Farhan was about to pay 3000. There was a balance of 3000. So it is saying that Farhan paid this amount 3000, but after 5% cash discount. Whenever we are getting some cash discount, so we will always assume that we are paying in cash. That's why we are getting the cash discount. We will say cash, and we have 3000. So we will get 150 discount of 150. We will say 2850, and now we have lastly the discount which was allowed to Farhan by a supplier, that is Jim D. Discount received. As Jim D is a supplier, So Farhan would have received this discount, so we will say discount received 150. The amount is 150. 150, how did we come to the amount of 150? We said 3000 into 5%, so the amount would be 150. Now lastly we will say 31st May balance CD. Now we will calculate the balance CD. We have 5400 on the credit side, 5400 on the credit side, and on the debit side we have 240. I have 2850, and lastly 150, that is 150. The balance CD is 2160, and here we will write down the 5400, the total. Sorry, I don't have space, that's why I am not writing the balance BD. Now obviously you know that the balance CD will be copied down from here. Now here we will write down 1st June balance BD, and the amount would come, that is 2160. In the next month Farhan has the amount of 2160 which he has to pay to his supplier, that is Jim D. Okay, now there is a question. Name the document that Jim D will issue on the following dates. Jim D sold goods on credit to Farhan. Now this time in the T account we will assuming that we are making accounts from the perspective of Farhan. That is, Farhan was a purchaser, was a buyer, and Jim D was a seller, but we are making accounts from the buyer's perspective. So that's why we have made the opposite of the account which all of the students were expecting in this question. So here we have made the account from the buyer's perspective. So for the buyer, Jim D is the supplier, we are making the account of supplier. Okay, for supplier we would say accounts payable. Accounts payable is a liability, so we were increasing the account on credit side. Okay, here we are making the documents from the perspective of seller. So Jim D sold goods on credit to Farhan, so obviously he would be making sales invoice. Now on 7th May, Farhan returned goods to Jim D purchased on 5th May. Whenever you would encounter any such type of source document asked in paper 2, always write credit note. There is no need to think on this. Okay. Now we have stated the subdivision of ledger in which the account subdivision of ledger, whether we say it's subdivision of ledger or we say it is the purchase ledger, all ledgers are called subdivision of ledgers. That is general ledger, purchase ledger, sales ledger. In general ledger, you all would remember this thing, that we have the T accounts such as sales, purchases, return outwards, return inwards. These all T accounts come in general ledger. And as far as sales ledger is concerned, all accounts of customers are made in sales ledger. In purchase ledger, all accounts of suppliers are made. So state the subdivision of ledger. Jim D is selling goods to Farhan, so obviously he would be making sales ledger. Okay. Now coming down to this grid, some students didn't ask me about how to go about for this grid, but I am making this grid in order to make it more comfortable, make it more easier for the students. Okay, coming down to the other document, capital expenditure, any expense on non-current assets or expense which increases the revenue generation ability of the business. Capital receipt, all income earned other than normal operations of the business. For example, the business was dealing in selling pencils, and in the business in any year the business sold some motor vehicles, some cars, some furniture. So that's why obviously the business would be making some proceeds, some income would be generated from there. So any type of income generated from other than the normal operations is called as capital receipt. And capital expenditure, any non-current asset expense. For example, I bought furniture and fittings, so that's a capital expenditure. And any revenue generation ability, for example, I had a motor vehicle which had only capacity of 2 boxes. So now I have purchased another motor vehicle which has capacity of 4 boxes. So this has increased my revenue generation ability because I would be selling more with a new motor vehicle. Revenue expenditure, recurring expenses, day-to-day expenses, electricity expenses, business rates, these all items are revenue expenditure which are paid again and again in a year. Revenue receipt, income earned from day-to-day operations such as sales of goods. Obviously, this is the only example you would encounter in your exams. So now we are doing this. Purchase of new computer, capital expenditure or revenue expenditure. Obviously, it is a non-current asset, so capital expenditure. Purchase of new laser printer, obviously non-current asset. Purchase of hard disk in computer. Replacement of hard disk, obviously this is a replacement, this does not increase the revenue generation, this is not a non-current asset, so we will write down revenue generation. Paid motor expenses, yes, it is a revenue expenditure because it is paid again and again. Purchase of motor vehicle for distribution, yes, obviously capital expenditure. Paid rent of premises, we will be paying rent again and again, so that is revenue expenditure. Paid rent business rates, so that's why it is recurring, and we will write down revenue expenditure. So in the end we have a question of this revenue receipt. We don't have any column for revenue receipt, so let's solve this again. This is also relating to the books of prime entry. Purchase goods $400 on credit from Jack. So books of prime entry, obviously this is related to purchase, so we will write down purchases journal. First we will solve this first column. Sold all the shop fixtures for cash $150. The value of fixtures was 200. If we are selling something, we will be using sold all the shop fixtures for cash. So if cash is involved, then we will say cash book. Any entry of cash or bank will be dealt with in cash book. Paid wages by cash, obviously cash is involved. Account to be debited, what is coming inside and what is coming to the business? Purchase goods. So goods are coming inside the business, so we will say we don't have any goods account, so we will say purchases account. The amount would be $400. Obviously there is only one amount in this, so credit Jack, because liability is increasing, that's why credit Jack. So credit Jack, so we will pay Jack shortly. Okay, there is no effect on working on capital. I've repeated this again and again. Any effect on profit or any direct effect on the capital will be written down in that column. Sold all the shop fixtures for cash, so account to be debited. Obviously furniture are going from the business, so we would say cash is coming into the business, so cash 150. Okay, what is going out of the business? Fixtures are going out, so the value of fixtures was 200. So now here we will write down $50. Now last, paid wages by cash. Paid wages by cash, we will write down wages account because it's an expense, so we will debit the wages account, and then we will credit. What would be credited would be cash $100, and there is no effect on this. Here the entry is not balancing. Obviously you all know that double entry should be completed, so we have cash 150 and fixtures $200, so the balancing figure is in both of these entries is $50. So that $50 is loss, that is income statement will be debited. Not income statement, it will be quite confusing for you to use this term income statement. We will increase the expense in the income statement with the name of loss on disposal. So now I am not writing no $50 because you would be confused with this, but understand this thing. Cash $150 and $50 would be the loss on disposal that will be debited in the income statement as an expense. It will be recorded in the income statement, so that's why the double entry will balance. $50 loss and $150 cash is coming. Fixtures in both sides you will see 200 and 200, then the entry will balance. If you have any queries, any comments, any questions, any problems, then you can comment below. You can ask me on my email. You would see my email at the end of this video. And do subscribe to my channel if you haven't subscribed. Like, comment, share, subscribe.